like to take away from the session, do let me know if that's in our scope today. I would be glad to cover that. Else, we could take it as a feedback, and maybe because there would be further sessions on this, and that could be coming as another session. So let's wait for 2 minutes, guys. In the meanwhile, feel free to type in your requirements or what you plan to take away from this session today. Thanks a lot. Waiting for your messages. 2:31.
So once again, very good afternoon to all, and welcome all to today's session. So those who are attending our session first time, we will share the link on the chat box so that you can go through the previous recording session that we held this last week on options. And those who are attending the session through our YouTube channel, we have already mentioned the link in the comment box, so you can go and watch the previous recordings of this earlier session. So today's session will be on the advanced option strategy, and I'm having with me Mr. Karan Pai, who will be taking this session ahead. All over to you.
Yeah. Good afternoon, everyone. Thank you all for joining in.
Before we proceed, Amit, there is a question from Amit who says that you missed the first session. As my colleague Rohit mentioned, we'll be posting the link in the chat box and you all can have a look at the first session. Second is, as you asked which session, was it buying more beneficial, selling more beneficial? So, Amit, each of these strategies, a buying strategy and selling strategy, both have their regimes when there is to be buying, when there is to be selling, and both of these strategies have their own pros and cons. And so it is completely dependent on the individual and the situation as to do you get in for option buying, do you get in for selling. So that is what we intend to cover out here. We intend to educate the investors and the traders as to what option strategy is good at what regime, when could you go in for a buy, when could you go in for a session. Yes, today is the second session. Today's second session continuation to what we had last Friday. And to have a view on the first session, we will be posting the link in the chat box. Else, you could go to the Access Direct handle, and there's and under the playlist, there's a playlist for futures and options. In that, you will get in the previous session's recording. That's with the same title as the option strategy, option trading strategies. Right, guys? So, Karan.
Yeah. Like my colleague rightly mentioned, to get a hold of what we had explained in our first session, what we would suggest is go to our YouTube handle. Under live, you will be having the recorded sessions that we have done earlier. And as far as taking today's session ahead, so today we'll be looking at some of the advanced option strategies, and I hope my screen is visible. First thing we'll be doing is taking a sneak peek of what we had covered in the previous session. This will be a quick run through because we don't want to spend too much time understanding what we did. So we went through the basics of options, understood what calls are, what puts are, what an underlying is, why options or futures are called derivatives because their prices are actually derived from an underlying. And then we went on to why we use options, where we saw irrespective of the market trend, whether it is bullish, bearish, sideways, you can use options. And also, we can take a decision based on the volatility. Now, I remember someone asking, how is buying better or selling better? So that is where something like volatility, impact volatility, historical volatility, those sort of things come in. Now, if these jargons or these terms are too hard for you to understand, or probably the first time you're listening to all these terms, then please don't be scared, because these are they mean something that is very simple, and simple for someone like me and my colleagues around, for you guys to understand. The third benefit of options is that it is fully customizable. I mean, you can build different strategies. Last week we had gone through the spread strategies. So then it is a defined risk for the buyer, as we had learned that. Defined risk for the buyer, because the buyer's risk is always limited to the premium that the buyer has paid, and then potential returns are higher due to leverage. Now, that does not mean that your risk is lower or something of that sort, but you have to always keep in mind that when you're building a position, the amount of money that goes out as an outflow is comparatively lower, and that is why your returns, when the market moves in your direction or in your favor, tends to be that bit higher. Now, again, call and put, the rights and obligations we had discussed. Now, we'll not be touching base on all these things. Then we had touched base on something called as understanding option terminologies like strike, premium, expiry date, and all those things. Again, those who want to, understand these things better, or quickly run through what is written in this PPT, then I would suggest you pause the video and take a look at it. Then we spoke about moneyness of an option. Now, basically, you might have come across the term called in the money, at the money, out of the money. Right now, exactly what it means, how you know that a particular option is in the money, out of the money, and how to scan for ITM or OTMs is what we had also explained. Yeah.
So another thing that was covered is the terminology that we have. So in India on NSE, we have index options as well as we have stock options. The reason that people get in for options is the margin required for buying options is less. As Karan already mentioned, you can play it for bullish buyers, bearish buyers, or even for sideways market. Custom defined strategies can be built up. We touched upon the put call ratio. What does the put call ratio mean? That is the total number of puts versus divided by the total number of calls. And these the on the extremes you see how's the market behaving, and they're trying to get back to zero point 0.5. So all these were explained in the first session. I would not want to get into much details, just giving a brief. Then we had touched upon long strategies. That is long call. Long call is basically when you expect the market to be bullish and do not want to spend that much of money. For long put is when you expecting the market to fall, and uh, so guys, I'm sorry, just getting distracted. Okay, any questions, please park it. I may come back to it later. If it is relevant, I'll address it immediately. Long puts is when you buy the put option for expecting the market to go down. Uh, so as we said, put ITM and so ways as then we had covered the bull spread and the bear spread strategy for the benefit of people coming for the first time and an advantage that we have something unique with us. I would explain to you all what's a bull strategy and what's a bear strategy. What's a bull spread and a bear spread call. So the entire term is bull call spread or bull put spread or bear put spread or bear call spread. I will come to that later. First, understand a bull spread and a bear spread. When you sell the highest strike price and buy the lowest strike price, it's a bull strategy. And when you sell a lower strike price and buy the higher strike price, it's a bear strategy. And when you put on these two legs using calls, it's a bull call strategy or a bear call strategy and bear call spread. And when you put on these using a put, it would either be a bull put based on the kind of strike prices they have sold, or the bear put strategy, depending on, as I said, depending. So if you again reiterating, guys, just remember this. To simplify it, a bull spread is the one wherein the highest strike price is sold and the lowest strike price is bought, and a bear spread is vice versa, where the lowest strike price is sold and the highest strike price is bought. And you use this using calls, add a call to it, and put bull call. That is how the spreads are defined. So coming to today's session, what we intend to cover in today's session, we would like to touch upon a brief on the options Greeks. So options are a pretty complicated instrument, and they cover so option prices are defined not only by the demand and supply, but there is a lot of other moving parts that get into options, namely the Greeks. The Greeks that we will be covering today, the four major Greeks, four major Greeks is the delta, the gamma, the theta, and the vega. This would just be a brief session on this, and
Yeah.
we will not be able to get into the very much of details because that needs each of these uh, Greeks would need two Greeks would need a session by itself. So just giving you a glance through of what these Greeks are. Karan?
Yeah. So, if you remember in our earlier webinars, we had mentioned that option pricing is a very complicated formula, correct? So, option prices are determined on multiple things. So, at so Greeks is a few. I mean, most of the option Greeks they make a few. They make up for the few moving parts in that formula. So delta is one of those. Now, when you talk about delta, you might have heard about option prices with regards to the price of the underlying. So what we are talking about is basically as we have mentioned here. So that is basically sensitivity of an option price to a unit change in the price of the underlying asset. So say for example, when I'm talking about delta of a Nifty call, okay, and if you see that the call delta ranges between 0 and 1 and the put delta ranges between 0 and -1. So why this is, we'll understand using an example. So over to my colleague who will, yeah, okay. So I'll continue and so when we are talking about say a Nifty call, say for example Nifty at the moment is trading somewhere around say 25,000 and आपका view bullish है, you go for a 25,100 call, okay. So because that is OTM at the moment the delta will be lower than 0.5. अभी से the market goes higher, मतलब Nifty जो है आपका 25,000 से 25,200 चला गया. So your option price will increase. Say for example, you had paid say somewhere around 50 rupees to buy the call earlier. Now because it is 100 rupees ITM, by default वो 100 rupees का तो value हो ही जाएगा. So जैसे जैसे आपका price change positive मतलब आपके direction में जाता है, your call option also increases. That is why your delta is positive. But वहीं पे we look at put, okay. अभी whenever the market falls, your option price will increase in case of a put. So that is why the put price is inversely related to the price of the underlying. So that is why a put delta will always be 0 to -1 and the put delta will always range from -1 to 0 and a call delta will range from 0 to 1.
So just elaborating on what Karan said. So let's say I see that Nifty currently is at about 25,369. So at the money put, let's say for example, would be 25,400. Let's think it for convenience sake. Uh, Bear with me, guys. I'm just checking what's the live prices right now. So we have the 25,400 put, and these are figures which I'm just giving you a rough estimate. This is nothing confirmed. So 25,400 put is something trading at about 111 rupees, 112 rupees. Let's consider for convenience sake at 100 rupees. So if Nifty, so since it's at the money, the delta is usually zero point 0.5. Since now let's say Nifty from here in the next 15 minutes, 1 hour, moves up by another 100 points. What would happen to that? So Nifty would go from 25,300 odd to 25,400 or 25,500. It's moved by 100 points. But would your call price also move by 100 points? No. That would be moving by zero point 0.5 of the total movement in the price. Right? So delta is exactly change the change in the option price, okay, as compared in relation to per unit change in the underlying asset, right? So that's the sensitivity. So if the sensitivity is zero point 0.5, so it will move by 0.5%. 0.5, that's a 50% of what the underlying has moved. And similarly, if you go further out of the money, so Anand, I'm not sharing the option prices. I'm just mentioning it. It's open on a different system. Focus on the PDF file. So So similarly, as you go out of the money, now delta, as you go out of the money, the delta keeps on increasing for a call. So or a put. So for out of the money, the delta gets closer to zero. In the money, the delta gets closer to one.
Yeah.
Okay, one or a minus one. And at the money, the delta is usually zero point 0.5 in and about that. Now, why, as Karan said, it is minus one, it is basically saying when the price drops by 100 rupees, right? So it's a drop of 100 rupees. So what will happen to the put price? That will also increase by that delta value, but in the negative, in the downside direction. So if the prices are going down, so it will increase by that much price. So that's the reason we are saying that it is a minus delta.
Yeah. So now that we have understood what delta is, we'll understand what gamma is at this point of time. So when we spoke about delta, we were talking about how the option price changes with regards to unit change in the underlying. Now we'll talk about how the delta changes with regards to the underlying price. Okay. Now understand this. जैसे मेरे कलीग ने आपको एक्सप्लेन किया 25,300 पर जब भी मार्केट चल रहा था 25,400 का जो डेल्टा है सॉरी 360 पे जब भी मार्केट चल रहा था 25,400 का जो डेल्टा है दैट वाज ट्रेडिंग समवेयर अराउंड 100 रुपीज अभी मतलब क्या है कि इट इज स्लाइटली नहीं इट इज एटीएम सो उसका 0.5 का डेल्टा है मतलब देयर इज अ 50-50 चांस दैट इट वुड एंड इन और आउट ऑफ द मनी बट एज द मार्केट मूव्स इन माय फेवर ओके अभी मैंने 25,400 का कॉल परचेज किया है जैसे जैसे मार्केट ऊपर जाएगा द प्रोबेबिलिटी ऑफ माय कॉल एंडिंग अप आईटीएम कीप्स ऑन इंक्रीजिंग सो as my option becomes ITM, my delta also keeps on changing. So that rate of change in the delta with regards to the change in the underlying is called gamma. Abhi, if I was to understand this, with regards to a simple real life example, it would be me traveling from Kolaba to Andheri. Okay, my distance is fixed. Abhi, delta would be the distance that I'm covering, and gamma would be the speed at which I'm covering it. So gamma becomes my acceleration. Acceleration, matlab I can cover a distance of say 10 kilometers in a matter of 1 hour. I can finish that distance in 30 minutes. The only difference is the gamma, the rate of acceleration, the rate of change in delta in this case is your gamma. जैसे जैसे आपका प्राइस ऊपर जाता है जिस स्पीड से आपका gamma change delta change होता है that is called gamma. So make sure you understand these things. अगर इसमें कुछ query है delta and gamma में please put it in the chat box right away. We'll hold for a second. We'll try and cover whatever queries you have regarding delta and gamma at this point. So when we are explaining the Greeks, please be very careful because जितने भी strategies आप आगे जाके build करोगे उसका सब base जो होता है that is always Greeks.
So as mentioned previously, delta is the highest at the money because that is where the probability of it turning into the money or out of money is highest. So as the gamma is again the rate of change of delta with regards to price. Similarly, gamma is also highest at the money. Right? So as somebody is asking for an example, so as I said, let's say today let's say now the 25, 300, 400 callers it is at 100 rupees, right? So when the market rallies to that, if the delta is 0.5, that 100 will not, so it is rallied by 100 points, so the option will also rally by once again option also rally by equal proportion to the delta, right? And as the market keeps on moving, the value of the delta will be changing. The out of the money will start coming towards the money, and that's the reason the from 0.4 it starts coming to 0.5 towards 0.5. The rate at which it comes from 0.4 to 0.5 is called as gamma.
So for real life examples, we do not have option Greeks on the NSE website as far as I know. But we do have it on our mobile app. So this will be explained.
So maybe we could have a live session of trading and showing you the options, but not now. This is right now we're just covering the theory and it's more on the educational side. regards to the execution, how do we look into the option, how is delta looked into, that can be seen through our app.
Yeah. So we'll make sure that some of the examples are explained towards the end of the session, and
So I have my colleague
yeah,
Rohit who's here, and at the end of session he will show you a couple of
ways to find out the option Greeks on our mobile app.
right. But guys, so as Karan said, have you all understood what's a delta and what's a gamma?
The difference between a delta and a gamma, because both are rate of change, but of two different factors.
So delta is the rate of change of price of the option, and gamma is the rate of change of the delta. Got it, guys? So delta, that rate of change is the gamma, and this is both depend on how the prices move, and based on that, there are changes in these two values.
Okay, so before going ahead, I'll give a small example. Say, for example, we are at 25,000 right now, and I go long a 25,100 call. Okay, because I am slightly OTM, my delta would be somewhere around zero point 0.4. Okay, so there is a 40% chance that I can end ITM, and a 60% chance that I can end OTM. So, Abhi, as the market moves higher, as we get closer to say 25,100, because my option is 25,100 call. Okay, मेरा delta जो है, my probability जो है, that goes from being 40% to 45% to 50%, 55%, 65%, 70%. So that is the change of delta. But what you have to understand is the speed at which my probability of ITM will keep on changing. Correct. That becomes my gap. Abhi, say for example, for every point move after 25,100, my delta is actually changing by say 0.05. मतलब बहुत fast change हो रहा है मेरा delta. So that is a situation where my gamma is more dominant in the option.
So that change in delta which happens from a 0.50 to a 0.55 as the price moves in my direction, that 0.05 is your gamma.
Yes.
The change in delta with regards to a change in price. Right. So again, so delta is what 100 rupees change in the underlying in Nifty. The option price will change by 50 rupees. Now for the option price to change in 50 rupees, the delta will have to change by, let's say, 10 rupees. So that, just giving you example in regards to rupees, these are all in percentages usually. That is the gamma. So the rate of change of your delta is in gamma. I hope you guys understood it. I'll take a 30-second pause. Any questions, please post it.
So we are having the question from a YouTube channel that how the premium decay occur.
So that premium decay is a part of the Greeks which will be coming to the later part. So as I said, there are four Greeks that we are covering: delta, gamma, theta. So theta is the next, which is plays a major part in the premium decay, and Vega. Right. So guys, 30-second pause. Any doubts? Please post it so that I can continue further.
With regards to delta and gamma, for the time being.
So we are having the question that is if you can explain through example about the delta.
So that's what I just said. Let's say right now. So as Karan, what Karan said, let's say you're moving from, so let's Mumbai from Dadar to Kolaba, right? And you are covering a distance of 100 kilometers. The speed at which you cover. So let's say you cover the speed at 60 kilometers per hour. That is your delta, right? And the change in speed, as the moment you raise the car and the speed changes from 0 to 60 in 10 seconds. So that would be your gamma. The change in the speed is your gamma, and the speed at which you travel is your delta. I hope that example is simple with.
Yes, that's good. Yeah, we can go ahead for the next slides.
Uh,
So can we write the
Mahesh,
formula?
I would not want to get into the formula and everything right now, because I'll tell you the entire pricing is based on a Black and Scholes model. So Black-Scholes-Merton model, as such it is called as. It's pretty complicated. I do not want to get into this. So let's not come into the formulas. Let's try understanding it practically, because the formulas may not help you trade or put in a trade. But if you understand the examples of how these things work, that will be a better part for putting in your trades. So Mahesh, thanks for confirming that the example was fine.
Now we'll move on to
Let's
the
move
next
on.
brief.
Let's come into the next two options, which we most of us have heard of, a theta decay premium. Rohit, would you like to answer the question? They ask you which website to show the options.
So that I'll be covering at the end of the session. We'll be showcasing you our mobile app, and from there I'll just showcase you that how you can see the option Greeks. Yes, we can go ahead.
So coming to the next, as we said, Theta and Vega. So one of the most prevalent terms that you would have heard in options trading is premium decay, Theta, premium decay, IVs, IV high, IV low. These are the two Greeks that specifically address those issues. Karan, would you take it up?
Yeah, so theta is basically time value. Abhi, when I was new and was doing my graduation, so one of the simplest ways to remember is using the TT for theta time value, VV for Vega volatility. So ये of course तभी mug up करने का मेरा तरीका था. But now what we have to understand is when we spoke about delta, being a probability of whether your option will end ITM, okay, ITM or OTM. So there is this time factor within which it has to end ITM or OTM. So जब भी हम लोगों ने option basics किए थे, so expiry date was something that we had touch base on. So your bet cannot be never ending, right? So आपका एक हफ्ते का bet हो सकता है, एक महीने का bet हो सकता है. So that becomes your time frame within which your option should end ITM. If it does end ITM, then its intrinsic value is your benefit, and if it ends OTM, then well, there is no time value, there is no intrinsic value, your option becomes zero. So theta basically, as the experts would define it, is basically the sensitivity of option price with regards to time.
So, guys, how would this matter? So, any option that you take in. So, as we said, we have in the money, out at the money, and out of the money options. So, every option would be having an intrinsic value. Okay, intrinsic value is what is the distance that it has from the current market price, or the strike price was a difference uh, from the market, and it would be having an intrinsic value. So options which are in the money, okay, let's say, let's coming back to the same example of Nifty options which I said. So if I look at, so right now as the market is 25,350 is at the money, and 25,250 option is roughly trading at about 200 rupees, right? So 25,250 took the current market price being 25,350, right? So 25,250 strike trading at 200 rupees, and the current market is 25,350. The difference between 25,250 and 350 is 100 rupees, right? So where do you get the extra 100 rupees from? That is this 100 rupees first is the intrinsic value. The extra 100 rupees that you see is the time value premium, right? That is the premium that you're paying for holding the options till the expiry. So in the money options usually have certain intrinsic value, and out of the money value. So let's say if similarly if I go for an option which is 25,500, right? The 25,500 option currently is trading at something about 70 rupees. But does it have any intrinsic value? No, because it is trading at a value higher than 25,350. So the intrinsic value here is zero. It has got no internal value. The entire 70 rupees is the time value premium. Now, how this time value premium changes with change in time, with change of every minute, every hour, change of every day, that is called as your theta. The rate of change of this premium is called as, and this premium change would in turn affect the change in your change in price, right? So that is the theta value that we are looking at. The rate of change of this is theta.
So when someone asked about theta decay, जब आप बोलते हो, so I am assuming that it's a short position, correct? So you will make money if the option does not end ITM or has zero intrinsic value as we move closer to the expiry, or it expires with zero intrinsic value. So that is theta decay. अंडरस्टैंड दिस आपके पास इफ यू आर गोइंग फॉर अ मंथली ऑप्शन करेक्ट आपके पास 30 दिन का टाइम फ्रेम होता है wherein your bet can go right or wrong. If you are right, you get your intrinsic value. If you are wrong, you lose the amount that you bet on having the intrinsic value. So you basically lose the time value that you paid to buy the option.
Another thing that we need to remember is at the money, theta is the highest because the option being in the money or out of the money, the highest probability is at theta. So I at the money at ATM. So the theta is the highest. That is the change of decay is the highest at the money. As you go out of the money, the theta value decreases. Secondly, as we approach close to the expiry, the rate of the theta keeps on increasing. So I'll give you an example. Let's say the theta value is 100 rupees as we saw for the in the money, and we have 5 days to expiry, which means theta decay. I'm just giving you a rough example. Don't hold me for this. Theta decays at the rate of 20 rupees per day. After 2 days, now when you come back on Monday, so this 20 rupees is gone. You say you have 80 rupees, but the market has not moved anywhere, and you have just 4 days to expiry. Again, let's say come back to 20 rupees. Market does not move, just 3 days to expiry. Now see what happens. Your rate of change is more than 25 rupees. Again, the market comes back just 2 days to expiry and you have 60 theta left. 30 rupees per day is going to be the decay. So as you approach closer to the expiry, the decay increases, the theta decay increases. Theta is always a beneficial thing for people who are selling options, and theta is a detrimental thing for people who are buying options because theta is always a negative value. You're losing 20 rupees, you're losing 30 rupees. So theta is always a negative value. So when you're selling value options, that theta becomes positive, a negative and negative becomes positive, basic maths. So theta is not favorable for option buyers and theta is highly favorable for option sellers. So guys, I hope the explanation of theta is good enough for you. Any doubts, please drop in a message. We will be glad to address it. I want you all to understand the Greeks in the simplest form possible. That could help and improvise the options trading leaps and bounds. Another 10 seconds to 20 seconds pause out here. So if there are any doubts, please post it in the chat box.
So those who are attending the session from our WebEx, you can post your query into our this chat box. And those who are attending the session from our YouTube channel, there is a live chat option is there, so you can post the query in the live chat option.
So just coming, Roy, if you're still connected with us, you had asked about the premium decay. I hope you've got the point.
Yeah. So moving on, you can keep typing in your messages, and we have to keep going because we are also theta negative at this point. so
So as we are approaching the close of the time, our decay is becoming faster.
yeah. So now we talk about the Vega. Now,
So Anandan, sorry, Karan, to cut you. Anandan, as I said, theta is beneficial. It's favorable for option sellers. You would not want your option to become in the money. You would want it to be out of the money so that entire theta evaporates because at the time of expiry, the theta has to become zero, right? There is no time left, so no time value premium. So if you're out of the money, the entire thing is time value premium. You want it to become zero, so it is for selling options. But when it is buying options, that is inbuilt. Correct.
yeah. So we'll move on, and now we'll talk about Vega. So there is something called as volatility. Now volatility मतलब एक दिन में एक underlying कितना move हो सकता है. Well, when I'm saying एक दिन में, I mean in a given time frame, what could be the possible movement in an underlying. That will tell me what my volatility basically is. Say for example, I'll put it to you with a very common example. I'll put it to you with put this in a very well-known example, which is basically an insurance premium. Okay. Now, this is something that is explained whenever you try to understand the probability of an event happening. So, earthquake is a very common thing in Japan. All right. So, the probability of an earthquake occurring is much higher in Japan, and this happens from time to time. So, if you purchase a house in Japan and you want to insure it for earthquake, your premiums are going to be higher because the probability of that particular event happening is much higher. And same thing, say India when compared to Japan is not as earthquake prone. एंड यहाँ पे अगर होता भी है तो it is mild major destructions. There have been major destructions, but it's not that frequent as it is in Japan. So in India, when you go and insure yourself against earthquake, it might be much cheaper than insuring it in Japan, correct? Because in Japan, the probability of that event happening is much higher. Now, another classic example: when you purchase a mediclaim, and if you tick that you're a smoker, the probability of, the premium goes higher. Why? Because the probability of the smoker getting, the lung diseases and all those things is much higher versus a person who is a non-smoker. So if the probability of a particular event happening is higher, okay, that is when your premiums are high. So now we will understand that with respect to volatility. So when I'm talking about volatility, if I am looking at say Nifty being volatile of say 100 points, 200 points a day, okay, do I say that my volatility is higher? For the time being, we'll say yes, it is higher because historically, we have seen that broader moves have been say 15, 20 points or something of that sort, hypothetically, and suddenly I see that my volatility has risen to 100 points a day. So when I'm pricing an option, which is I'd say 25 100, which is 100 points OTM from my current market price, the price of the option will already price in the increase in the volatility because the probability of my option ending ITM has gone up. So that is basically volatility. So if your volatility is higher, your option premiums are going to be higher. Now volatility also increases whenever there is an event. अभी for example Fed meeting हुआ या इंडिया में elections थे, US में elections है, ऐसे सब जब भी होता है, so there is a lot of speculation about one particular political party coming into power, one particular political party losing and all those things. So during these times, the markets are taking into consideration multiple factors because of which the volatility is increasing. Correct. So a policy continuation might be positive. A policy continuation in certain cases might not be positive. So we are uncertain of the outcome. So the volatility will be a bit higher because we have bulls and bears both putting in their logic, both trading both sides, pulling the market on either sides because of which the volatility goes up. So this is when your volatility comes in play. Now another example of someone had previously asked what is the option decay or theta decay, something of that sort, correct? So another thing is volatility cooling off, which leads to your option prices falling from B to A or from 10 to 5. So understand volatility is basically the the historical changes or something that we have observed over the past a few over a past time frame, and based on that your option price, the sensitivity of that particular factor affecting your option is basically Vega. So now we will halt for 30 seconds. We'll understand. If you have any query on theta and Vega or gamma and delta and gamma, please feel free to type in.
So I see there is a question from someone, Sanjeev, who says that if I buy a 25,400 call of 19th September, I'm sorry, and 25,400 call of 26th September, how does Vega differ in them? Thanks. Okay, so understand this thing. Vega is the change in IV, and IV affects, the greatest effect of IV is in the time value portion of the option, right? So if you have a longer dated option, so 19 is the immediate option, nearby expiry, and the further dated expiry is 26th. So if you have greater time, so there will be greater time value premium in the 26th option, right, and lesser time value premium in the 19th option. So obviously the option Vega of the 26th September is going to be higher as compared to the 19th. I hope you all got that.
So another way of putting it is, in this example, I'll just take 1 week to expiry and 2 weeks to expiry. So with my underlying moving, say 100 points every day, the probability of a 600 points OTM call ending ITM with 2 weeks is much higher. Correct, because अगर say for example मैं 100 points every day मेरा underlying अगर move कर रहा है and I have 1 week to expiry, the if assuming that every day there is a 100 point positive move, एक week में I can cover 500 points, correct? Now this is very crude, very hypothetical, but अगर given that I have 2 weeks with 10 working days in it and a 100 point positive move every day, the probability of my option call, my OTM option call ending ITM is way higher. So always the sensitivity of volatility will also change based on the
It will be
expiry.
proportional to the time value,
Yeah.
the time that's the expiries. So the time left will be proportional to the IV also. It will be a proportional to the IV will be proportional to the time value. So Vega will be affecting accordingly.
Yeah, so
Yesterday market movement, how will it affect Vega? Okay.
so one simple way of telling this is just go to TradingView, put in any option call, any option, the call options, and just see how the market, how the particular option moved,
So-
and you'll be surprised.
Yesterday, most of the options, the call options, have closed at least 3x to 4x to their opening values. 3x, 4x, some have been 20x. I don't want to get into that. So that was not only the effect of IV. Understand that it was the expiry yesterday, and most of the options started, which are out of the money, started getting into the money. So the delta kept on changing, the gamma kept on changing. So two factors changing. Theta was practically in the last day, there was nothing. There was no theta towards the end of the session, right? IV started cooling off. So a thumb rule, not exactly a thumb rule, but usually it has been observed that as the market rallies, the IV cools off, and as the market falls, the IV, because there is a lot of anxiety, there is a lot of uncertainty coming in the market, and the market stops falling, right? So accordingly, the demand for option premiums is higher, and hence the IVs also increase. The IV with the intrinsic volatility also increases, implied volatility. I'm sorry. So that's how IV is being affected by the movement in prices. So yesterday's price movement was not only IV, guys. As a matter of fact, IV was cooling out. Theta was negligible. So yesterday's price was basically gamma. We call it as a gamma blast, or I would not call it as gamma blast. I do not want to get into the gamma blast. So basically, understand as the options, as the price started moving, the options started coming into the money. So from a point 4, the delta went to a point 5 in a matter of minutes. So think of, so let's say if you're driving a car which has got to cover 10 kilometers and you cover it at the speed of 100. So from starting from 0 to reach a speed of 100, think of the acceleration that your car will have. That is what gamma is doing. So gamma rose exponentially, which caused the which caused the delta to increase, and that caused the price increase as well. So understand, that's what exactly we're trying to understand. Theta and I Vega, that's IV play an important role, but they are not the only ones. We've got a lot of moving parts within options. So these are the first level derivatives of options. That's delta, theta, gamma, and vega. There are also second level derivatives of this, which we would not want to get into right now. That's pretty complex. So for the timing, have you understood what we have covered, the ground that we have covered till now?
The Greeks that we've been.
So we are having the question from a YouTube channel that Vega role in calendar spreads.
So calendar spreads, I would be coming to at a later strategy, at a later point of time. That is when you would get into the Vega role. So because that needs more in-depth explanation, more in-depth example. So I would not be covering it right now. Right now we're just covering the example of the concept of Vega. Vega roles, how do Vega or IVs affect a particular strategy is what we will come to when we are discussing the strategies. We are taking a couple of strategies today where we will be making you all explain the role of IV, what kind of IV affects what kind of strategy. So guys, a 10-second pause again. Let us also catch some breath, and if you have any questions, please do post it. I hope you all have understood as to what has been covered till now so that we can proceed. Do drop in your questions. Let's take a pause for 10 seconds. See ya. So, guys, I think this is enough for the theory as of now. Let's come to the more interesting part, which everyone is interested in, these strategies. As we said in the previous session, we covered four basic strategies. That is a long call, long put, and the bull call and the bear call, bull and bear spreads, right? Now, oh, Mahesh, you understood the meaning. As long as you understand the meaning and try to get over it again and again, you will be able to explain. If not, maybe post this session you could have a read through. If not, you could drop us a mail, and the idea here is to explain things to you. As long as you explain, understand the whole thing, that's great.
So again, we are having a question from our YouTube channel that technically how to know the India mix has a breakout or breakdown.
So, guys, it's a very complex topic. India wakes, IV breakout, breakdown, but there is a way that we follow, that we look at it. So, what we look at is what is today's IV as compared to the last 100 days high low. Based on that, we decide what has been the IV percentile. So, sometimes if the IV percentile is 30, that means only 30% of the time the IV has been lower than what is current today's value. So, the probability of IVs increasing is higher. That's where we take a call. Okay, the IVs can increase, and let's get into strategies which are long IV. If the IV percentile in the last 100 over the last 100 days comes to 80, that means 80% of the time the IVs have been lower than this. There is a probability of the IVs cooling off. So let's get into strategies which are short IVs, or which basically benefit from IVs cooling off. So this is one of the ways that we do it. So there is nothing as a breakdown or a breakout or a breakout or a breakdown of the IVs, but more quantitative is we look at the IV placement as compared to what it was in the past. Apurva, I understand that you bought some puts and options and some shares. So right. So being honest, we would not entertain any individual strategies or individual recommendations. You could, but we would be glad that you could call up your RM and maybe he could advise you. We, as a policy, would not take this up on the because this session is completely for education purpose only. This is not for recommendation. This is not a live trading. Maybe if there's a live trading coming up, we would come up with that in future, but not right now. Secondly, compliance issues. We're not in a position to give out strategies. Right. So proceeding, guys. As I said, now let's come to the part wherein we would discuss. So the strategies that we plan to discuss is today a long strangle, a short strangle, a long straddle, a short straddle. So that when Rohit takes up the session to get the option Greeks, maybe he'll help you out to how to look at the IVs for the last 100 days. For me, if you ask, we since this is a firm and our job is this, we keep a track of the IV values over the last 10 years, 20 years, whatever it is. Right. So as I said, the option strategies that we cover would be a long strangle. The opposite of that is a short strangle, a long straddle, and a short straddle. Why these two? Why a straddle? So the unique thing that you see is a strangle and a straddle. Why these strategies? Because these strategies are more or less similar in nature, right? And so, what is a long strangle? Guys, imagine just if you can imagine this thing. There is a guy who's standing and somebody's trying to strangle his neck. So they have to be at two ends of the rope to strangle him. So that's the way the long strangle. That's the way the strangle is. Right? So how do you build up a strangle? So let's say your underlying is at price S as we mentioned here. So one out of the money call is what you buy and one out of the money put is what you buy. So for let's say today's situation live, if you're talking about
Now, this is not a recommendation. This is just a hypothetical
guys, yes, this
scenario.
is just I put an example scenario to give you all a better understanding of the example. So right now, let me refresh the data. Rohit, what's the current? Okay, let's do it live so that trust me, it is simple once you understand, not too complicated. So NSE India, we get into the option chain. My network's a bit slow.
So let us first understand in what situation.
So we'll come to that, Karan. We'll come to that. And what situation do we? Let's just first explain the structure. Sorry to cut you there. So as we see, even right now, the at the money, the market is at about 23,353. So at the money would be 23,350. So what would be out of the money? For me, anything above the strike price, above the current price is out of the money on the call side. So what would that be? Let's say we call it the 25,600 strike. Why the strike? Is just arbitrary. There is no logic to it. So I'll come back to this 25,600 call and a call that is trading at 35. So let's convenience sake, let's put it as 36 rupees. Now what does the strategy say? One out of the money call to be bought and one out of the money put to be bought. So what is out of the money put? A strike price lower than the current price. So that's a strike price lower than the current price. Let's take 25,100 or 25,000, similar pricing. 25,000 put. That is at 33 rupees, the 34 rupees. So 25,000 put at 34 rupees. So guys, what's the total premium that you pay is 36 plus 34 rupees, that is 70 rupees to create this position. That's 70 rupees into the lot size. So I will be just speaking as per unit. Remember, all the prices are into the lot size. And how does the payoff look like? What's the payoff diagram? The payoff diagram is how much a profit or loss will you make in relation to the movement of the market. Right? So right now we've spent about 70 rupees. So the maximum loss that we can have is just 70 rupees, right? So that is what you see here. If you see this blue line, this graph out here, that's the payoff diagram. So once you go beyond a particular level, so that particular level is what? What is your outer strike price plus the premium that you have paid? So that is 25,600 plus 70. So once you start going beyond 25,670, you start getting into profit. So that's on the upper side. So if the market rallies from here, you will make profit, and what will be the extent of profit? That could be unlimited. I hope I'll just zoom this a bit so that it is more clear. Guys, I hope this is clear.
And for those of you who feel that it's not clear enough, then you have a zoom in, zoom out option when it comes to WebEx, and in YouTube. Also, I think okay, fine. Yeah, in YouTube also you have that option.
So right, so I was coming when if the market has to rally, after what point of closing will you make the money? So that's 25,600 is the strike price. You spent about 70 rupees. So the market has to cover that 70 rupees also. So it has to go beyond 25,600 plus that 70 rupees, and anything beyond that, every single movement that you make, you would end up in the profit. The profit could be unlimited, depends on how much the market rallies after that. Let's say the market falls. What happens in that case? In that case, what happens is after a point of the fall, you start making money. So what's that point? So where have you sold the put? You bought the put. You bought the put at 25,500 plus a premium. So another 70 rupees fall is required. So basically, you require a 24,930 movement. After that, that is when the options start making profit. So you understand this whole strategy. A long a long strangle will make profit if the market rallies or even if the market falls. So as Karan was saying, when do you build up this strategy? Karan, what do you think? When do you build up this strategy?
So whenever I feel that there is going to be a volatility expansion.
Exactly. So this strategy will build up when you think there is going to be a huge movement, but you're not sure of which direction it is in. That is where you put a trade on both of the sides. The premium, again, since it's a long, is limited to the premium that you're paying. That's the loss, that's the maximum loss. It is limited to the premium that you're paying. And since it's a long call and a long put on both sides, you end up making money if the market rallies. If your view and your direction, if your view comes out to be higher, where the market, like election, exactly, Mahesh, like the election result, you did not know is it going to be positive or negative, and you see the way the market fell. So had you put up a call or a long straddle that day, the market would have made, you would have made money out there, right? So Karan,
Yeah.
so that's the long strangle, right? So long strangle, as we said, you buy one out of the money call or buy one out of the money put, wherein the call is, so the call price is higher than the underlying, which is in turn higher than the put price, right? So the call and the put and the strike price, the current underlying lies between the call and the put. So next, coming to a short strangle. So you all know what's a strangle. The strangle is when you're buying out of the money call and a put. That's a strangle. When you sell it, that becomes a short strangle. So it is again the similar thing, selling out of the money call and selling out of the money put. So what happens out here? Let's say I have, so let's take in the same example, and let's say we putting in, instead of a buy, we are selling these two options. So you see what happens to the payoff diagram. The payoff diagram is exactly inverted. Now in this strategy, what happens? In this strategy, your loss is unlimited, your profit is limited to the premium that you have got. So what is the premium? The total. So when you sell the call, you get a premium of 36 rupees. When you sell a put, you get a premium of 34 rupees. The total premium is 70 rupees. So your profit is limited to that premium. Whereas the loss, if the market rallies wildly or falls wildly, you will lose money. So Karan, in what situation would you put up this strategy?
So whenever I believe when the options are costlier.
Not only that, when you're not sure, when you think that the market might not give a big movement in the next few days or next few weeks, that is when you put up the strategy. Second, these strategies are governed by the IVs, as somebody was asking. So at this point of time, because of the uncertainty being there, the IVs are usually high. And that is, let's say, one of the situation would be before the company results, when the company announced their results, wherein you're not sure of which side the market may move, but you are sure that the market will not range much. It's not going to be a 10% movement up or down. The result could be better, bad, or in line, but the market might not move on. Right? So you would want to make some kind of money out of this. That is where you pose the strategy, wherein the entire premium is what you get into your account, and you would want the market to rally, being within these two strike prices. Yeah, Rohit?
So we are having the question one from our chat box that will I get the recordings of this session? Yes. So this session is already live in our YouTube platform. So directly from our YouTube channel, you can go and subscribe it, and you can watch the recordings of these sessions. Yeah.
Yes.
So we can go ahead.
So on the strangle side, there is a long strangle, there is a short strangle. Guys, I'll take a pause of 10 seconds here. Just let this sink in, because before we rush in, let's just sink in, and let us know if you have any of your doubts. Please post it here.
So those who are attending the session from my YouTube channel, they can go into the live chat box and they can post their questions there.
Guys, since we've explained these strategies and most of the Greeks, just let's ask you a question. Sometimes, okay, this is just to see if you actually catching up what we do, what we're teaching you, or what we're trying to put out the message out here. Sometimes you see you buy a call, okay, you buy a call, your market view is right, and the market does rally. It gets into the money, it does rally, but your call ends up losing money. Why do you think that happens? Guys, I repeat the question. You buy a call, market rallies, your view is right, market does rally, or it does not rise much. Let's say it does not rise much. So it does not rise much, you lose money because of theta decay and everything. But let's say it rallies, but still your option does not rally as much, or maybe ends up losing money. Why do you think that happens? And has it happened to you? I'm sure you might you to trade options. You think such a situation has ever happened to you?
So I'll put it in this way. Geopolitical tensions जब भी होते हैं, okay, and there is a lot of uncertainty about demand and supply of crude oil. Now, in this example, I'm changing the underlying, but when there is a lot of uncertainty, and crude oil may say, for example, your technicals are telling that it is bullish, and you go long a call. And in the evening session, whenever the US markets are active, sometimes there is a massive rally in crude, but you tend to lose or gain not gain as much as the crude moved. या theoretically जितना आपको मिलना चाहिए था उससे आपको कम मिला.
So Amit, I see that you answered here. That's perfectly. That's the Vega cooling because when you bought the call, as Karan said, geopolitical situation, uncertainties, the IVs were very high. Now once the market is taken a direction, the uncertainty is gone, and you know that the market is going up. Everyone is factored in all the uncertainties that's coming, and the market is taken a direction. So uncertainty goes away, your IV starts cooling, your Vega starts dropping, and that's the reason. So as we said, different moving parts. That's the reason your call does not end up making money as expected, or rather starts losing money. Right? So guys, strangle, I hope it's clear. Long strangle, short strangle. As Karan said, you put up a long strangle when you think that it's going to be a wild movement in the market, but you're not sure of the direction. A short strangle when there has been uncertainty and you think the market for now will not have such a great movement and would be in range for some time.
So with the short strangle, one thing you have to keep in mind is that your stop losses should be in place. Now, अगर आप देख सकते हो कि market कोई भी direction में जाएगा, you will end up losing money. So we don't want to be in a situation wherein if the market moves, we will end up losing money. So you should have your strict stop losses and do not go in for adjusting these strategies. You have to always keep that in mind also. Now we'll touch base on all those things at a later stage, but these are some points that we wanted to highlight very specifically because आप देख रहे हो कि यहाँ पे your losses are unlimited if it goes below a certain level and if it goes above a certain level. So if you see that the market is going out, then the best thing to do is set your stop loss and get out of the trade.
So, guys, proceeding next, as we said, the next strategy that we coming up to is the straddles. So, another layman example which I'll give you all. It's quite funny as I told you about the straddle. So, straddle, where is the straddle being used? You ride a horse, you see the straddle, so you sit with your legs across. So, that's a straddle. That's how the payoff chart looks like. Sorry, very crude example. So, what happens in a strangle, in a straddle? I'm sorry, not a strangle, a straddle. So as we saw in this triangle, we are buying out of the money call and out of the money put. But in a straddle, we are buying the call and the put at the same strike price, usually which is at the money. Not necessarily different strategies you could put in, but you buy the call and the put at the same strike price. So Karan, tell me again, why would you put up a long strangle? Why would you put up, when is the situation that you will put up a long strangle?
So a perfect example would be, in a situation where we are not expecting, there is some sort of event that could be lined up and you don't know what the outcome of that event could be. Now, one of the example would be, when I remember this distinctly because when crude oil was trading around $98, the WTI crude was trading at around $98. There was this Russia-Ukraine war that was going on. So one fine evening, we had these discussions about UN stepping in and stopping the war or Russia escalating the issue. So ऐसे situation में होता क्या है? The market could move in either direction. Correct. So ऐसे situations में something like a long straddle could help you because when it was at around 98, I remember वो 100 का थोड़ा crucial level था and it could have a fantastic move on either direction. So that is a situation when you could use something like a straddle.
So here I have another follow-up question, Karan. Then when do I use a straddle? When do I use a straddle? In both cases, we expect the market movement to be higher.
That is a very good question. So
this is to the audience.
Yeah.
What do you think about it? When do you put up a strangle? When do you put up a straddle? Why? Because both are used when the market is supposed to be giving a wide movement on either direction, when you're not sure of the direction, right? So why would I use a straddle than a strangle?
So
any guesses or any answers or anyone who would like to answer this? If you could drop a message in the chat box or on the YouTube live comment, I'll give you 5 seconds for this. Is anyone? Let's proceed. As we said, we are running short of theta right now. So what happens is both are done in the case of a wild movement or a large movement being expected on either side where you're not sure of the direction by the Nifty. Ganesh, that's one of the points. I'll come to that. But understand this thing: for a straddle to be for a strangle to be profitable, it has to cover a substantial distance. It has to, as we said, 25,670 or 24,930. But in case of a strangle, the break-even points from where the profit starts will be slightly closer, right? Will be slightly closer. That is the advantage of a straddle. The advantage of a strangle, as you said, as somebody mentioned, that the capital required for a strangle, or for a straddle, let's say since we're talking about straddle, for a straddle is higher than the long strangle. And why do you think that happens? Why do you think the capital required for a straddle is higher than a strangle? Very simple, guys. For the straddle, you're using at the money options, and for the strangle, you're using out of the money options. Out of the money options are cheaper. At the money options, having the higher theta, vega, and everything, they are always expensive. I hope this point is clear. Straddle, strangle, both are used when you expect a volatile movement in either, but you're not sure of the direction. You're expecting a huge movement in which could be either direction. Strangles, strangles, strangles require lesser premium. Straddles require a greater premium, but the strangles would need a slightly larger movement than a strangle for it to turn profitable.
Yeah, and Mahesh, so Axis Securities is the name of our YouTube handle. The links are also posted, but you could just go on to YouTube and search for Axis Securities.
Guys, now as we saw a long strangle, a short strangle, now we have a long straddle. Okay, fine. Since we're doing the payoff chart, let me get to the payoff chart quickly, which will be of so. What is the at the money? 25,350 is at 126.20. So let's get it.
So we are getting very close to the expiry of today's session. So
this is Axis Securities webinar. We can have extra theta built in. Rohit?
Definitely.
So put is at 132.95. Just correcting this 24,350. And what happens? Both are a buy, and a buy. So you see the total premium you are requiring is 250, let's say 260. So see here what happens, right? But as I said, what would be the break even here? So you're putting a 25,350 on the put side, on the call side. So you see your break even on the buy side of the call, or for the call, is 25,609, 70 points lesser than the straddle, right? We had put in at 25,600. Now similarly, we see it for the put side. You see that 25,090 instead of 24,930. So guys, get this. You have the break evens coming up earlier in the straddle, but the premiums are expensive. Strangle, the premiums are cheaper, but the break even is slightly spread. So this, again, I'm showing is the payoff chart. As we said, your losses are limited to your premium that you have paid. And if the market rallies and takes the direction or has the volatility as expected by you in either direction, you end up making profit. The profit could be unlimited to the extent of the rally or the fall, right? I hope this is clear, guys. So now the opposite strategy to a long straddle would be a short straddle. Karan,
yeah,
asking you again, and I would want you to take this up. So when would you put a strategy? So guys, so it is very similar. I'm just coming to this, instead of going long at the money for both the call and the put, we go short. Karan, when do you think I will put up the strategy?
So, like my colleague earlier explained, when we do not expect the market to move very widely, So that is when we put up something like a short strangle or a short straddle. Absolutely right. So a sideways market, you see that a particular underlying is going to be sideways, or probably within the range of your break-even points. So we, as my colleague had shown the break-even points, if you think that at any point of time it is going to be between those 2 points, that is when you deploy something like a short straddle or a short strangle. A short straddle, as mentioned by my colleague, there are a few benefits, there are a few pitfalls. So, sorry, a long straddle and a long strangle, they have their own benefits, they have their own pitfalls. Similarly, a short straddle and a short strangle also have their own benefits and their own pitfalls. Now, first thing, when you are shorting, you have to keep one thing in mind, that you are the receiver of the premium. So, जब आप straddle short करते हो as against a strangle, जहाँ पे पहले आपको 70 रुपीज एज अ प्रीमियम मिल रहा था, यहाँ पे आपको 260 मिल रहा है. बट देन हम लोगों ने देखा था कि वहां पर जो मेरा रेंज था कंसोलिडेशन का, it's way more broader. That means I'm that bit more safer in consolidation, or uh, yeah, I'm talking about the strangle. When the short strangle, the range is way broader. So I'm that bit more safer, if there is say 100 or 150 point move. But in case of a straddle, when you're short a straddle, your range is actually tighter than a short strangle. So here, an exponential move like we had yesterday evening, it can take you out very fast. So again, the benefit is when you're short a straddle, you receive more premiums, but your range is a that bit more tighter. But when you're short a strangle, you receive fairly lesser premium, but you have a bit more comfortable range.
So the trade-off here is higher premium, lesser range, lesser premium, higher range of safety.
Yes.
Right?
And again, one thing goes without saying, that these payoffs, they clearly show you that your risk is unlimited. Whether it's a short straddle or a short strangle, you have unlimited risk. So the first thing that you have to do when you build up a position is have your stop loss in place.
So guys, now coming to how IV affects and theta affects these two strategies. So long strategies, as we said, is negative theta. So these strategies, you want the market to move rapidly and fast, so that your theta decay is covered by the rapid movement. Second, you want these strategies when the IVs are low. When the IVs are low, so that is when you go long. Because if you go short, as we mentioned previously, if you go long when the IVs are high, the market may move, but the IVs will cool down and eat up in your option premium. So long strategies, guys, are good when you have when there would be a rapid movement within a short frame of time in any direction, and when the IVs are low. Short strategies are when the IVs are pretty high and the market is when you have a view wherein the market will not move beyond particular limits on both the sides. That is when you see that the theta decay comes in, you get the entire theta decay, the IVs start cooling, that also drops down the option premium, which is your premium that you get to eat.
So one question that I would like to put on to everyone who is in this session, WebEx or YouTube. So if I'm long an option, now that we've gone through the Greeks, if I'm long an option, what are the Greeks that I'm long and what is the Greek that I'm short? Just recap what we had discussed. एंड अब मेरे को एक ही बात बोल दीजिए कि अगर मैं एक ऑप्शन लॉन्ग करता हूँ कॉल या पुट, when I'm long a call, let us say a call, okay, when I'm long a call, what are, okay, Amit, again, bang on, but along with delta, you are also gamma and vega long. सो जब आप द लॉजिक इज वेरी सिंपल. अगर आप एक कॉल परचेज कर रहे हो, यू एक्सपेक्ट द मार्केट टू मूव इन अ पर्टिकुलर डायरेक्शन. मतलब यू वांट द डेल्टा टू गो अप. Because the delta goes up, you are long the gamma, because gamma is the rate of change. And you also want volatility, because अगर फास्ट ऑप्शन जितना फास्ट आपका अंडरलाइन हिलेगा उतना आपको ऑप्शन में पैसा आएगा, करेक्ट. बट एट द सेम टाइम टीटा इट गोज अगेंस्ट यू. सो मतलब टाइम इज अगेंस्ट यू, सो योर टीटा शॉर्ट, मतलब टीटा इज गोइंग अगेंस्ट यू. The same goes the other way around when you are short an option. Correct. जब भी आप option short रहते हो, the theta is actually working in your favor. So you are theta long and बाकी सारे Greeks जो है आपके ये हो जाएंगे short हो जाएंगे. So ऐसे situation में you can so in any given situation you can either be Vega long or you can be theta long. You cannot be long on both. So if you are long the theta, you are short the Vega. मतलब अगर आप कोई ऑप्शन शॉर्ट कर रहे हो, यू डोंट एक्सपेक्ट मच मूव इन द ऑप्शन इन द अंडरलाइन, बट आप ये एक्सपेक्ट कर रहे हो कि इट विल बी अ ब्रॉड कंसोलिडेशन एंड वो आपके टाइम वैल्यू जो है वो आपको बेनिफिट करे.
Right, guys, so for today, this is what we wanted to discuss or have a chat on. There are many more other strategies which will be coming up. So we currently touching base on strategies which will feel relevant to the investors or our investors. So what we discussed initially was a single leg strategy where you see there's only one option buying or selling. Then we touched upon two leg strategies of bear call options and bear put and various bear and bull strategies. Today we've tried to get into more on wherein we look at the IV and the thetas and the Greeks into play, but again a two-legged strategy wherein there is a buy and a sell of a call and an option at the same time. Going forward, we'll be coming on with three-legged, four-legged strategies. So these, as Karan said, straddles and strangles have unlimited losses. There are strategies which you can put in wherein the losses can be limited, the premiums may come down. So we have iron condors, butterflies, various other strategies that we will come to eventually. For now, this is what we have to discuss about. In the meanwhile, guys, if you have any doubts or any questions, please post them. Right? So we will take a cut.
Yeah. So after today's session, after understanding Greeks, I hope you guys will start looking at options from a whole different angle.
Right, and in the meanwhile, that you'll post the questions. I would request Rohit for the demo on the mobile for the Greeks and how to see the Greeks and the IVs. And I hope you all like this. I would look for feedback from your end. If there's anything else that you want us to cover going forward, I hope this was a session wherein of some benefit to you. Rohit, could we start another 30 seconds? Guys, we'll take a pause for 30 seconds by the time Rohit gets ready, and meanwhile, feel free to post your doubts and your questions.
So thank you, thank you, Karan, for giving such a great insight about the Greek options and the strategies. So I'll quickly walk you through on our mobile app that from where you can look at the Greeks specifically, as there was query related to the that where you can watch the Greeks options. So once you log into our mobile app, yes. So once you log into our mobile app, you can simply go and search for, let's say, I've already searched for the Fin Nifty call that's for 25,000. Now, once you go here, then you can find out the market depth about the charts. I'm sure like the screen will be too small, but yes, you can zoom it at from your end so that you can see the entire, screen actually. Now, here you can find out the entire overview that how the market depth this looks like, that both bid and ask. Then you go into the option chain. Now there is a toggle between the futures and then the option chain. Once you go into the option chain, you can see the entire data on the option chain on the call and put side. So there is a small icon that's a Greeks. Okay, once you toggle that, then you can see directly the entire Greek options, that's delta, theta, gamma, vega. So from here you can go and find out the entire Greek options and the values of the Greek options. And simply like if you, for example, let's say you want to go ahead and buy the 24,000 or 25,000 call right now, then you can simply click on here and click on the buy option. Then you can see the required margin also. So as like Karan was explaining you about the strategies, then I will also showcase you that we are having the predefined strategies also in our mobile app. You can go into the tools section and click on the options strategies. Now let's say like my view that if you are a no voice trader and if you don't understand about the market, then you can simply go into this tools and click on the Nifty 50 or the Bank Nifty, any of the index. Now let's start with your view for this Nifty 50. Just a minute, I'm again sharing my screen. Yeah. So I click on the bullish, that I'm bullish into the Nifty 50. I click on the near futures and I can see all the single leg strategy that is already defined here. You can simply click on the details and you can find out the entire payoff graph what Karan showed you in the Excel. And simultaneously, if you want to execute the strategy, you can execute it. Simultaneously, if you want to go ahead with the multi-leg strategy, तो multi-leg strategy में already हम लोगों ने वहाँ पे bull call spread, bull put spread दिया रखा है. Now, if you want to execute with the bull call spread strategy, click on the execute and you can see the margin what is required here. That is 12,779. So as Mr. Karan was explaining to you that in the spread strategies, you are having the lesser margin. If you go with the straddle or strangle strategy, then normally like your margin will be approximately between 80 to 1 lakh. So that's a multi-leg strategy. Now all over to you, Karan.
Karan, Rohit, there's somebody asking that in any strategy, when the target is set or exit, will be when? Does the strategy automatically exit from the defined setting? So I think that's a part of the mobile app feature, right?
Yes.
So and V Kumar, as you said, we need a practical example when the market is open. Yes, we will come with that. We have certain clearances to be obtained. Once that is done, we would surely want to have a live session wherein we could demonstrate the power of our app as well, and the various strategies that we're talking about.
So V Kumarji, I like to take your question, but the market is closed right now. I would have showed you the real life example here only that how this strategy works. So let me come back to you next week, and then accordingly I can show you the live case, real life example on this strategy part.
So, just guys, just recapping. So, in the last two sessions, we covered what is options about, what are different types of options, what is the definition of a call, the rights, obligations, different strategies like a long call or long put. Guys, I'm sorry, I think I was muted. Just recapping, in the last two sessions, the last two Fridays, we covered what is options all about, what are, guys, I hope I'm audible. Yeah. So, as I was saying, the last two sessions, we've covered what is options, what are different type of options, what is the rights and obligations for call and put, different kind of strategies, single-legged strategy like a long call, long put, multi-leg strategy like what's a bull strategy, what's a bear strategy, and how accordingly using calls and puts that becomes a bull call, bull put, and we covered that. Today we touched upon the option Greeks. Trust me guys, what we touched upon is just the tip of the iceberg. Greeks itself would need, as I said, a complete session by itself. But we tried, and I hope we all could get an understanding of the different Greeks which actually contribute towards the option pricing. And lastly, we touched upon the strategies using certain directional bias or certain market bias, or having a view on the IVs as well. Further, we plan to get in another session where we get into execution, or we get into more complex strategies, as I said, like condors, butterflies, ratio spreads, back spreads. That should cover off most of the option strategies which are relevant to an investor or a trader. And going forward, we also plan to have a live session for the benefit of our investors and traders, and that would be communicated to shortly. Rohit, anything else that you would like to cover?
So there was one query that from where you can find out the research reports. So I'll just showcase you that from where you can find out all the research reports which are uploaded. So I'm just sharing my screen. Just give me a couple of seconds. So you can visit to simplehaccessdirect.in, and I'm sure my voice is audible to you all and the screen is visible. Now under the research section, you can go and see first of all the research ideas what our research analyst published. So यहाँ पे आके आप trading ideas देख सकते हैं. So these are the trading ideas what we have already published it. So if the call is closed, then automatically it mentioned here that call is closed, and all the strategies, all the research call related to the future options is published here. Secondly, if you want to read the research reports, you can go into the research report section and go into the trading reports. So there is an investment reports also and trading reports. So I'll explore the trading reports right now. And under the trading reports, you can find out the daily technical reports, daily derivative reports, and the weekly derivative reports. So every week during the expiry, that's on Bank Nifty and the Nifty 50, we publish the strategy that is related to the call spread strategies. So these strategies reports are directly published here. So you can go and download it at 9 a.m. The strategy reports. So at 9 a.m. the strategy report downloaded. It's published here and you can download it from here. So with this, I'd like to thank everyone for attending today's session, and over to you, Karan.
Yeah, so thank you all for joining in. Thank you all for joining in. I hope you have some intrinsic value left after the expiry today, and you have gained some insightful things. My colleague would also like to say something.
Also, guys, there is a lot of other research reports, more on the quantitative side that our team comes out with. Please look out for mail notifications, app notifications from our end. We have new, I would say, new generation reports come out, which is like a weekly probability on a sector-wise basis, weekly probability on commodity-wise basis, the market breadth, but with a different outlook, not the regular advanced decline ratios, and many other such reports. There are also certain snippets and certain information put up on our social media handles. So do join our Twitter and LinkedIn handles. Give us a shout out. Do like our handles, repost. We would look for more participants from your end. Trust me, that will be more encouraging for us. Uh, do watch out this space for some more information, some more sessions coming up to your way shortly. I would like to thank everyone for taking time out and having participation. Hope we've done justice to the time that you've given. I'm done from my side, Rohit. Up to you.
So once again, I'd like to thank you everyone for taking out the time on this weekdays and attending this session. I'm sure you can just type in your comments that hope you liked us this session and you enjoyed and you learn about the Greek options and about the strategies. Again, next week on Friday, we'll be coming up with the multi-leg strategies. So do join us for that sessions also. So you can directly post your comments and
Thank you, guys. Thanks a lot.